Kia ora, ngā mihi nui ki a koutou. E na rangatira mā, nau mai, haere mai, whakatau mai, ki tēnei hui mariko. Ko Barry Kotahu, ko te kaiarahi, o te patea whai whakaaro. Nā reira, tēnā koutou, tēnā tātou katoa, tihe moriora. So, a very warm welcome to you all. I'm Barry Coates. I'm CEO of Mindful Money. This is the fifth in our current series of seminars, and they're held on Wednesdays at 12 o'clock, 12:15 rather. And the videos and podcasts of previous seminars are available on the Mindful Money website. So please check in there because there have been some very good ones. Today, we're talking about climate change. To some extent, it seems early to be talking about climate change. Households and communities across the New Zealand, particularly across the North Island, are still suffering from Cyclone Gabriel, and we should pay our respects and say that our hearts are with those who have been forced out of their homes, having to clean up often for the second or third time, starting repairs, but also caring for those who are injured, traumatized, or even people who have passed away. So we acknowledge and feel for their suffering. On the other hand, it's also the right time to be talking about climate change. There is no doubt that warmer seas and other climate-related factors made this cyclone far more intense and destructive than it would otherwise have been. And this really should be a call to action if we want to prevent more such events, or even far worse and unimaginable impacts that are yet to come from runaway climate change. I do think that today we have an opportunity to hear about one of the key issues with climate change, particularly the companies that are producing fossil fuels, and the movement to try to encourage those companies to move from fossil fuel production into renewable energy. To lead our discussion, I welcome Mark Campanale. I met him 30 years ago when I was working in the UK, and worked with him on setting up the first ethical investment network in the UK. Since then, he's been one of the world's leading researchers and thinkers on climate finance. So without further ado, here's the video of the interview with Mark. Carbon Tracker pioneered the concept of stranded assets and the carbon bubble. They provide insights on climate action, including transition analysis for the members of Climate Action 100+. Prior to forming Carbon Tracker, Mark was co-founder of some of the first responsible investment funds at Jupiter Asset Management, NPI, AMP Capital, and Henderson Global Investors. Mark was one of the founders of the UK UK Sustainable and Responsible Investment Forum, otherwise known as UCSIF, a member of the steering committee of UNEP's Financial Sector Initiative, and Mark's now on the advisory board of GFANZ, the Glasgow Finance Alliance for Net Zero. So, Mark, very warm welcome. Thank you very much for joining us.
Pleasure to be with you, Barry.
Mark, I want to start out talking about the International Energy Authority's energy transition pathway. So they've set out their analysis of a pathway that's broadly consistent with keeping global temperature rise to less than 1.5 degrees C, rather broadly defined. Is that a starting point for your work and the Carbon Tracker initiative work on transition pathways?
Yeah, Barry, we have to start with the science and what the scientists are saying. And the scientists are telling us that 1.5 degrees above of warming above pre-industrial levels is absolutely top end of the upper limits of change that the Earth's systems can sustain or live with, and that going beyond that starts to accelerate tipping points and irreversible changes, the consequences of which we can model but are beyond our comprehension. And these are changes that will last for, potentially millennia. So we use 1.5 as a target. And so when we look at the IEA scenarios, it has to be said that it's within that context. So we do support the IEA 1.5 net zero. Whether it's achievable or not, given that the remaining carbon budget to 1.5, how much CO2 we can put in the atmosphere, we're running down into less than the 10 years based on current emissions. So whether it's achievable or not is another question. We're likely to get significant overshoot, and which we've got to pull ourselves back from the cliff. But when we look at, say, the plans of the fossil fuel industry, it has to be set in the context of the IEA 1.5 net zero being, in my view, the best one that we should be using. That's the most conservative one from a scientific point of view.
Right. And we already see in New Zealand some of the climate-related natural disasters that are occurring, even as we're still well short of 1.5 degrees C, although approaching it. We see it in developing countries, of course, which are very much on the front lines, including our Pacific neighborhood. So Mark, from that IEA, International Energy Authority report, they conclude, I think there's no need for new conventional oil and gas development, and the need to be production declines by 2030. So how is the energy industry tracking against that advice from the IEA?
They're doing the complete opposite, Barry. The oil and gas industry is planning huge increases in production. We've studied this and published on this. So we have a report, carbontracker.org, it's called Paris Aligned. And some of the companies, if you look at their planned investment and the licenses they own and the expansion plans that they've announced, some of them are way beyond 2.5 degrees to 3 degrees warming. Most, if not all of them, have capital and expenditure plans, the idea of developing more, which is completely inconsistent with IEA 1.5 net zero. And we find none of them have a pathway really that gets us to 1.5. Some have got some very heroic assumptions about the use of nature-based solutions. One company alone plans to reforest the globe the size of land equivalent to the size of India, and that's just one of the companies. Insane assumptions, and because they want to continue the use of they want the internal combustion engine to survive, and they want the world to continue to use liquid fuels in a combustion engine, and they can't see any way that we can come off it, which we know is not true, because we have things called electric vehicles, and we have mass transport, and we've got other forms of transportation that we can use. I don't think that we can say that the world's leading oil and gas companies are anywhere close to being Paris aligned with their plans, or even 1.5 degrees. We're not the only people saying this. Carbon Tracker is saying this, but our allies and other researchers who analyze this, the same companies have come to the same conclusions as us.
I think in your briefing, Paris Aligned and other materials, the thing that's really shocking is not only that the reductions aren't fast enough, but as you point out, in fact, investment is being put into expanding exploration and production, and that I found quite shocking. What do you see are the likely consequences of this?
Well, we have to cut emissions by around 50% over a decade. And if fossil fuels is the main contributor of climate change, which it is, their plans to expand production, it's a bit like, and then the investors support it, it's a bit like the pension funds announcing decarbonisation goals and going down the escalator and then continuing to invest in more production. So the pension funds are now turned round and are running up a downward escalator. And so they've announced goals to decarbonise whilst at the same time making their problem even worse. So the consequences of this, there's a kind of an economic theory, Say's law, that says supply creates its own demand. So one of the consequences of this huge supply is inevitability that the demand will appear, policymakers will not do the necessary interventions to constrain production, and that we have a situation we have now, which huge amounts of capital is going into expanding the fossil fuel system. And there's just an illustration. The largest IPO, initial public offering, in the London market last year was an oil and gas company. It was the 5th largest in Europe. So we can study this, actually. So what Carbon Tracker does is we study all the listed coal, oil and gas companies. We can analyze how much carbon dioxide is in their reserves, and then we can compare that to the remaining carbon budget to 1.5 degrees. So roughly, the carbon budget to 1.5 degrees is around 300 gigatons, with a 66% probability, possibly up a little bit or down a little bit, but that's what it is. The listed companies alone in 2011 owned 700 gigatons, so twice the remaining carbon budget today. But we republished our study last year, Unburnable Carbon 10 years on, and the amount of CO2 in the reserves of listed, stock exchange listed companies, the ones that you will own in your pension fund, has grown from 700 gigatons to 1,060, okay? And that's just the listed companies. Governments own a further 2,500 gigatons of CO2 in their reserves, so state-owned oil and gas companies. So add the two together, you've got around 3,600 gigatons of CO2 in the world's known fossil fuel reserves. The remaining carbon budget is 300 gigatons. So you can do the maths. We've got 10 times more fossil fuels than we can possibly burn. And yet financial regulators and exchanges and markets and banks are allowing the banking system and the pension fund system to finance even more exploration and production. And that's really where your problem of stranded assets and inconsistency is. So if 90% or more of the listed companies' reserves have to stay in the ground, why are they exploring even more? Why are they funding even more development? And that really is the problem that we've got today, and why the expansion plans of the oil and gas companies is such a problem. It creates financial instability inevitably. So if you look at the loans to the fossil fuel system through the banking system, the size of their loans is roughly equivalent to what's called the tier 1 equity of the banks. So banks have to hold back capital against their loans as a risk control measure. It's called tier 1 capital. The regulators require it. And the idea is that if you make losses, your tier 1 equity will absorb those losses. And when you crash through your tier 1 equity, which is what happened in the crisis of 07-08, the mortgage crisis, those mortgage loans were worth nothing. So the tier 1 equity crashed and the banks had to issue new shares. And when nobody could buy the new shares, government stepped in, if you remember, and bought the shares in the banks. That's what the financial recovery was governments buying shares in the banks to recapitalize them. So today, the size of the loans by the banks to the fossil fuel system is equal to their tier 1 equity. So that's the level of risk that is going through the financial system. And Carbon Tracker, and in our report, The Size and Decline of the Fossil Fuel System, we estimate there's around $30 trillion of assets, coal mines, power stations, railroads, oil refineries, the people that use oil and gas, and the demand infrastructure that exists within the financial system, $30 trillion. That is around 4 times greater than the financial crisis of 07-08. So that's the scale, really, of the potential losses, of write-downs, and the size of the change that we need to make. And we're going to have to lose about half of the revenues and the assets of the fossil fuel system over the next decade, as we replace it with a new energy system.
So the implications are both global financial instability, plus also huge climate risk for the companies that have continued to invest and not made the transition into renewables. So why do you think the reluctance to make that transition? Is it partly because we've recently seen a rise in fossil fuel prices? We
Well,
certainly seems to have
no,
seen an
it's a
increase in
paradox.
investment from.
It's a paradox, okay, because on one side, renewables are getting cheaper. It's the cheapest form of energy in most, if not all, parts of the world. And it's growing exponentially. So 70–80% of all the new energy that's being installed globally is renewable. And it's chipping away at demand for fossil fuels. So we've got that happening on one side. So we reckon that based on current rates of growth, within a decade anyway, we'll have moved substantially towards a renewable energy-based transportation and also power system globally. So we would be making those changes. What we've got at the moment is very, very high prices for, relatively speaking, for oil and gas. So last year, or the year before last, oil was down at $20 a barrel globally, and at one point even went negative. Today, it's roughly around $80 a barrel. Now, if you're producing oil and gas as a company at $5 a barrel, and some are, like the Saudis, and below $5, and you can sell it at 80, you can see that they're creating huge amounts of cash. And that's why investors are going, we'll take the dividend now, we'll pile back in, forcing up the share prices of the oil and gas companies. But the opposite of this is true. What can go up can also go down. And what we know from history is that looking at the US coal companies, the difference between them being vibrant and successful and in bankruptcy was very minor. So a 2% change in demand for coal in the US, 2% drop, led to a 90% drop in the share prices of the US coal companies. And COVID, a 6% drop in oil and gas demand, led oil to being in negative prices below $20 a barrel. And it's the post-COVID recovery back to where we were before that saw demand grow, and then obviously the Ukrainian crisis and Russian supply coming off, that led to oil prices accelerating back up again. So what you've got is pension funds. Remember, pension funds are really for the long term. They're supposed to be investing for 30 years. You've got pension funds acting as commodity speculators. They're in for the short trade. They've come back in. They've taken a 1 year or a 2 year view. In the same way that people buying mortgage-backed securities in 07, 08 said, well, we can always sell these. And as soon as we got in, well, maybe you can, but not when everyone else is selling. And that's the challenge of the fossil fuel system, is that people think that they can time it. They know when to get out. But if everybody tries to get out at the same time, that's when you get a market crash. And that really isn't a conservative approach to managing an asset like a pension fund. So when you hear of pension funds going back into the fossil fuel system, knowing that it's structurally in decline, what they're doing is gambling with people's money.
Yes, and I think Carbon Tracker Initiative's done a great job in raising awareness about the concept of stranded assets and climate risk. It just seems slightly unbelievable that despite the warnings, not only from you guys, but also from Mark Carney and others, that hasn't really been taken on board by much of the investment community. Mark, just to finish off, how do you see this playing out in terms of that dynamic of what the trigger points are for a change in the demand scenario, or a disruption of the fossil fuel sector, causing a real downturn? You know, sort of obviously you can't predict the future, but what
Yeah.
kind of conditions do you see as creating that change?
Well, okay. So I'm not the first to say this, but it's worth saying again. We're the first generation in human history, really since the Neanderthals, where we can heat, cook, move ourselves, and power ourselves without burning something. So since the days of Neanderthals sitting in caves when they had to set fire to something to cook or keep warm, today we don't need to set fire to anything. So for cooking or for heating, we can electrify everything. And that's what's happening globally, electrification of pretty much everything, transportation, power, through solar, through wind, heating, through induction, through air source heat pumps or ground source heat pumps, and induction cooking. So the end of the fossil fuel age is inevitable. In 10 years ago, 5 years ago, there weren't cheap, viable alternatives to, a gas boiler in the UK, what, £2,000, £3,000, air source heat pumps are getting down to roughly the same. And once you've got them, the running costs are less than the cost of the gas. It's the same gas-fired power. We've now got solar with storage that's cheaper than gas-fired power. And that's growing on S-curves of exponential growth. And so we're replacing a fossil fuel system with a clean energy system. And that's unstoppable because of the law of economics. As things get cheaper, mass adoption, wider assumed use, more electric charging points, cheaper electric vehicles, we're making that shift. And so this is a structural change. The mistake investors are making is they think that the ups and downs of demand for fossil fuels is cyclical. It's not cyclical, it's structural. This is an irreversible change because of cheap, widely available renewable energy. And the fossil fuel system is a bit like if you've got a printer in your household. What you're really doing is you've bought a printer contract, an ink contract. The cost of the machine is often less than the printer ink, and they know this. They want you to buy forever printer ink. The fossil fuel system's the same. When you buy a car, they want you forever to go to a station and buy their product. It's called oil. And the same with the gas-fired power in your house. Now, once you move to renewables, once you've paid off the cost of your installation, there's no input. It's free forever. The wind, the sun is free. And so you're destroying the economic rationale that the fossil fuel system is built, that concentrates wealth in the hands of relatively small numbers of people. You end that system of control by powerful corporations and Middle Eastern governments. And you replace it with a new system of dispersed, widely available energy that you can create at the household level, and it gets cheaper. So households will end up with more cash in their pocket because they're not spending it on expensive petrol and expensive energy. So, and governments dependent on the fossil fuel system, whether we're talking about Venezuela or Russia or Iran or Saudi, I don't really care the political color. Once the world goes into renewables, the despots of the world will not have the financial support, and they will in turn fall over. So clean energy is helping to democratize the world as well as create a clean, widely available system for all. That's the direction I see it going. I'm very hopeful. I just hope I'm around long enough to see that change happen. I think I will be. It's an exciting time to be around, Barry.
Change is certainly happening, and it's happening at quite a fast pace. I remember the Saudi foreign minister had a saying that the Stone Age didn't end because they ran out of stones, and the oil age won't end because they'd run out of oil. Which I thought, coming from the Saudi foreign minister, was quite prescient of him. Mark, thank you so much for that absolutely fantastic work that you guys do, and you've been such a pioneer on this stuff.
It's great to see you, Barry. I tweet on this stuff daily at Campanale Mark or through Carbon Tracker at Carbon Bubble, and people can stay in touch and hear what we've got to say and see our new reports. All of it's free.
So, without further ado, I'd like to introduce first Jessica Cairns. Jessica is the head of ESG and sustainability at Alphinity Investment Management. Uh, Very warm welcome to you, Jessica.
Thank you very much, Barry. Thanks for having me today. So just firstly, I'd like to begin by acknowledging the traditional owners of the land that I'm beaming in from today, which is the Gadigal people of the Eora Nation here in Sydney, and just pay my respects to elders past, present and emerging. So I'll keep the intro very brief because we are running short on time now. So Alphinity is an Australian-based investment manager based here in Sydney. We manage portfolios that invest in global and Australian listed equities. Currently have about 18 billion in funds under management and have a pretty small team, all in the one office of about 18 people. We have two different types of funds. So just to set the context for the discussion today, we do have two dedicated sustainable funds that invest around the United Nations Sustainable Development Goals. We do exclude fossil fuels from investment in both of those funds, one domestic and one Australian equities. But across our core funds, we do invest in fossil fuels. So for example, we invest in companies like Woodside, a little bit in Santos at the moment, not very much on our domestic funds, and then global, we invest in companies like Next Zero Energy, for example, which is a large utility. So when we think about fossil fuels and oil and gas, we do have a view that there is, it's a little bit confrontational coming up against Mark's video just then, but we do have a view that there is a need for oil and gas in the immediate term, and we can obviously talk a little bit about what that means. But the way we, really think about it is from that stewardship perspective. Investors really have two decisions, when it comes to fossil fuels and other sort of negative industries. You divest and don't invest, or you do invest and you aim to influence and make positive outcomes. I recognise that investors, still have a long way to go, I think, in actually achieving those outcomes of really making meaningful change in the fossil fuel sector. But that's sort of how we think about it, and think about that sort of benefit of ongoing engagement and active engagement and keeping these assets in the light, where investors actually do have an opportunity to influence rather than going into, say, the private markets, which is what happened to thermal coal, where, you don't really know sort of what's going on anymore. So I'll stop there, but happy to obviously get into it shortly.
Thanks very much, Jessica. And just to let you all know that when we're talking about specific funds and fund providers during the seminar, we're talking about investment strategies. This is not financial advice for any individual or recommendation to invest in any particular fund. If you have questions, then you should go and see a qualified financial advisor. So thanks very much for that. Let me pass to David. David Lewis is on the panel as well. So warm welcome to you, David. David is founder of Novus Consulting. He was a lead author in a recent survey of climate action across the New Zealand investment sector, and he's formerly Deputy Chief Investment Officer at Milford. So, David, can you give us your perspectives on firstly on kind of fossil fuel issues across your career and your current work?
Tēnā koe, Barry, and thanks for having me on the seminar. I guess across my career, across the last 20 years or so, in the investment sector and more recently into sustainability, there's been a huge change in the way that mainstream investors have been thinking about fossil fuels, and much more awareness of the key issues in climate change in the more recent years, but still a wide range of approaches and a big variation in sort of the intensity in which people think about that, and still some huge gaps versus the types of targets that the IEA and other, as Mark pointed out, bodies of independent international scientists say we need to get to. So the investment industry is making a bit of progress in terms of thinking about fossil fuels, but still huge gaps to where we need to be to get to keep 1.5 alive. And that's obvious if you think about that near-term target of reducing emissions in half by 2030. We now need to be falling at sort of circa 10% a year in terms of annual emissions, and that is looking like a very, very difficult task at the moment. So, and the big oil companies obviously have a huge role to play in that, and very useful to have the likes of Mark's work doing some fantastic analysis into what's really going on there.
Great. Let's come to some of those issues raised by Mark in the video. But first, I wanted to start with something that's a little bit foundational. In the old days, the traditional investment community would have said that their job as investment managers is to make as high a return as possible for the given level of risk, and that the impacts of their investment is not really their responsibility, a form of kind of Milton Friedman, like the business of business is business and not anything else. That view is changing, but can I have both of your perspectives on to what degree do you see issues, particularly climate change, as starting to become something which is not only a financial risk to be managed, but actually something more a responsibility of fund managers as key drivers in the financial system. Jessica, what's your perspective?
Yeah, it's interesting, the whole fiduciary duty sort of concept, I think, especially with the energy crisis last year, and then the sort of what they call the anti-ESG movement coming out of the US, as well as, regulatory changes on greenwashing, I think has really sort of brought a lot of the investment community back to that concept that ultimately, and obviously depends on where you sit in the chain of investors, but ultimately the responsibility is to deliver returns for your investors or your clients or your customers or members or however you define it. I think where it's changing when you're thinking about ESG is that more and more investors are thinking about the sort of longer term consequences when it comes to ESG, and if you think about fossil fuels, if you just think about today, and, BP is a very interesting example of this. 8 days ago, they announced reduction in their carbon emissions and in their carbon emission targets and pulling those back, and the share price bounced, because the market sees that is, it's them refocusing on core business and focusing on the opportunity today. I think where people are starting to go with this is maybe today that's a good thing, but in 10 years' time, I think most people in the market agree that we are on a path towards a transition, and it is important that these companies shift over time. Where it gets a little bit tricky is exactly what that time frame looks like, and investors need to balance where we want to be versus where we are actually going. And I think that's where the sort of, the tricky thing comes in. So I think it is changing. Investors are definitely thinking about the E and the S sort of components and the bigger picture, and how the sort of ultimately transitioning to net zero is a good thing. But there is still that obligation. I don't think anybody can ignore it completely. There is still an obligation to manage returns in the immediate term, and that also, needs to be an important part of the conversation as well.
I remember living in the UK some years ago when BP rebranded as Beyond Petroleum with the promise that they were going to invest massively in renewable energy. And just recently, as you say, Jessica, we've had BP profiteering from the huge rise in oil prices as a result of Russia's invasion of Ukraine, and then giving larger dividends to their shareholders and winding back on their transition commitments. So it does call into question as to how serious the commitment of many of the major oil companies is to this transition, despite the promises. David, what's your perspective on it?
Firstly, just to pick up the points from Jessica in terms of fiduciary duty, which has been a keenly debated issue in recent years. But I think, the bulk of opinion now is moved to a place where, managing climate risk and thinking about responsible investment more broadly, should be considered as part of fiduciary duty. And, we've had that important legal opinion out of Chapman Tripp here in Aotearoa, New Zealand, about 2 years ago that reached that same conclusion. And that might challenge some, more traditional investment thinking focused on return. But I think when you think about, the quantum of the risk that's involved to an investment portfolio, over time, as well as in the short term, that's where, thinking about climate risk becomes a critical part of fiduciary duty, because, it is going to be, one of the most important determinants of, economic and investment market performance over the next 10, 20, 30 years. And, investors need to be considering that risk when they design strategies and design portfolios. So, the debate has been more challenging in the last year and a half, given the move in oil prices that we've seen and the performance, the sort of shorter term returns that have come out of a lot of these companies. But I think it's important to bear in mind that for those investors that were able to get that timing right, they have enjoyed some great returns. But if you're looking back over a longer term, there's still a huge gap between what the market has done generally and what oil stocks have done. I mean, over 15 years, that gap's still at 7% per year. So you've sort of made 5 times your money in the broader market and about 1.5 times your money in oil stocks. So, fantastic for those few investors who might have been able to time it right and sort of, get that short-term investing perspective correct. But, I think that's the bulk of investors have been invested here over time, have really struggled from a return point of view. As well. And just to pick up your point, Barry, in terms of BP walking back their targets for reducing emissions for the second time. As you say, they've done it just a week ago, and they did it in the early 2000s as well. I think there's a real credibility gap, which Mark and the team at Carbon Tracker highlight really well in the report, the Paris Milan report, which I encourage everyone to take a look at if they haven't done so already. Really credible report, great authors. They have a lot of experience, the authors of that report, in the E&P sector and appraising these projects. And that sort of highlights that gap between what the majors are saying in terms of their net zero commitments and their nice ESG sections on their websites, which are, sort of putting out one message around what they think about the energy transition, and then their actual production plans, which for many of them are actually for flat to increasing production over the next 20, 30 years, which is completely inconsistent with with anything but sort of 2.5, 3 degree warming, which is pretty catastrophic. So a few comments there. Very.
Yeah, and for a country like New Zealand that's experiencing kind of the climate extremes at about 1.1 degree of warming, the concept of a continuation of emissions up to 2.5 or 3 degrees is a pretty frightening prospect. And I should say that we will kind of feel for the plight of the people who are suffering from Cyclone Gabriel, kind of even as the seminar takes place. So it is an important context for us. Mark Campanale talked to us around the extreme scenarios on financial risks, and the numbers that he's talking about are huge, and the disruptions that he talked about are huge. Are you convinced by these, or do you see a more gentle landing possible for the fossil fuel industry as they're able to make that transition and avoid the kind of abrupt dislocation to their finances and to financial markets as a whole? What's your feeling on the kind of time and likely pathway for that, Jessica?
Yeah, I can start, I guess, just in the context of gas, and I think that's probably been one of the more sort of contested areas Everybody's pretty comfortable that thermal coal is well and truly on its way out now, and oil will have somewhat of a role, but it is small to date and will continue to be relatively small in future. Gas is interesting, you know, and obviously last year or the year before, when the EU taxonomy kind of finalised the recommendations on including gas as part of its sort of approved list of energy sources, but with the condition that there's carbon capture and storage attached. And I think that's the one element that I find really interesting in this debate, that we assume, so looking at the sort of numbers for gas, you know, that Mark was sort of talking about on the amount of reserves and things that the companies are kind of pushing. If we assume that all of those gas reserves are burnt using today's technologies, which essentially releases all of those emissions up into the atmosphere, then yes, you know, obviously we are well and truly going to exceed 1.5, and our view is that that will start to taper off in the sort of 2030s, 2040s, once hydrogen, because I think the view is currently, you know, it's going to take until about 2030, 2035 for hydrogen to really take off properly. And until that time, gas isn't going to really go anywhere, because it's still very necessary for a lot of industrial processes. However, if you sort of bring into that argument the role of carbon capture storage, and I know this is quite contentious, and I'm not, you know, a technical person, I'm not an engineer in this space, and I'm not a geologist. But when you have a look at the IEA NZE report, and you look at IPCC predictions for 1.5, gas plus CCS to generate hydrogen is definitely part of this story. And I think that that's just an important sort of element to think about, because potentially, and some of the numbers in the IEA report indicate that 40% of hydrogen in 2050 will be generated from natural gas plus carbon capture storage. So that's a significant amount of the hydrogen pool that will actually be generated from natural gas as a starting point. And potentially, if that all kind of plays out, I'm not sure where that lands in terms of those kind of total numbers that Mark was talking about in production, and how much gas we actually need, and whether the assumptions that Carbon Tracker are kind of using include that or don't. And potentially, because carbon capture and storage is still quite contentious, and a lot of people believe that, particularly in Australia, believe that it's unproven and not working. But we're seeing, you know, in parts of Europe, this is taking off like crazy. There's 73 facilities across Europe and the UK now. Places like the Netherlands are incentivising this development. So that's something that I think for us is something that we're watching really closely, because I think that will change the dynamic of how much, you know, gas we actually need, and how some of these big oil and gas players will actually move from what they're doing today towards, you know, what they call new energy or renewable energy space.
Sorry. So you're just muted there, Barry, but I'll add and comment. I mean, I guess to me that sort of speaks to, you know, some of the technology risk around this transition. And yeah, I mean, there's no pathway through to 1.5 degrees that doesn't rely to some degree on carbon capture and storage, which is, you know, currently basically unproven at scale. So, you know, there's a hope and an expectation that that those technologies will improve over time. But, you know, to me, you know, we really need to have as many options on the table as we can in terms of these technologies, in order to really mitigate and deal with that huge uncertainty that you have across this entire spectrum of deeply interconnected issues. So yeah, it would be fantastic if carbon capture and storage turns out to be a lot better than is currently expected, and then, you know, that provides scope for some of the other technologies to maybe not advance as quickly or become as cheap, or it provides scope for, you know, some of the fundamental climate tipping points that could occur in terms of, you know, ice sheets and, you know, the frozen methane trapped in the soil up in the Arctic, etc. So there's so much uncertainty around so many different areas that it's fantastic if one of the technologies proves to be, very good. But I think it's also quite risky to rely on that as, the source of the transition. And yeah, as I mentioned, there is no pathway to 1.5 degrees. It's not assuming that we get some of it. So, if we're actually not able to do that at scale at an economic cost, then that's actually problematic, and the starting point is worse. So, yeah, it's, time will tell a bit with those. Yeah, I think it's right to be very hopeful with technology, and, for investors to make an allocation and try and provide some funding to helping develop those technologies, because that's likely to be very good from an investment return point of view. And it also supports the way that most investors talk about their responsible investment policies and their sort of philosophical approach to these risks. So yeah,
I think part of the problem is that carbon capture and storage has been an excuse for business as usual for much of the oil and gas industry, and the Carbon Tracker initiative makes a point in their reports that it's still a very unproven and small scale technology, and it's costly at a time when there are renewable alternatives that are still reducing in cost and are already competitive, and so I guess their view would be to be very careful about relying on it for any substantial effect. For those who are listening, I'd very much encourage you to go and have a look at Carbon Tracker Initiative's documents. They've got a number of good reports on there, including a recent one on S-curves on the rapid takeoff of new technologies, battery storage, renewable energies, that hit an inflection point, and then their adoption becomes very rapid. So it's in a way providing some optimism that actually the climate solutions end of the spectrum in terms of renewables can take off very quickly if the conditions are right and if it gets a push. The other thing is I guess Mark would say that even if you are optimistic about carbon capture storage, there's still an enormous amount of transition that has to happen in the industry. Jessica, for you as somebody who knows kind of the investment world from Alphinity, Mark talked about the danger of people thinking that they can just hop into the market, make some profits while prices are high, and avoid the inevitable price declines and share price crashes. How does that look from your perspective, and particularly from the perspective of Australia, where it is such a major part of the Australian economy? Do you see a growing nervousness around that point at which the market really starts to decline rapidly as demand starts to fall?
Yeah, I think it's been a really interesting time. Like energy and metals and mining generally are always a really material part of our index here. So, having exposure to large kind of metal miners and the energy sector is fairly normal for most managers here. And it's actually can be quite challenging to manage portfolios that completely exclude energy. Obviously, what we saw last year was the takeoff in the stock prices of all of the energy stocks, significantly increasing that index weight and making it even more challenging to exclude fossil fuels. And interestingly, I mean, this is anecdotal and we would never say who, but interestingly, like I said at the start, we did have we exclude fossil fuels in our two sustainable funds. And we actually had circumstances last year where we had some of our larger clients that are in those funds approach us to discuss alternatives, because of the concern about the immediate losses. And I think, not to harp on about the fiduciary duty kind of thing. But ultimately, investment managers are answerable to investors, and if you miss by a quarter, that is an issue. That can be an issue, and if you miss by a year, that can be an issue as well. So there's definitely like a lot of talk about how certain ESG funds or sustainable funds strategies can, include things like gas on the basis of the EU taxonomy, including it, or how they can bring in fossil fuels or for a period of time. That's not something that we would do as part of our fund. Like we've maintained our mandate, but it just is an indicator of the type of conversations that are going on, because I think there is some nervousness. Yes, it will come off eventually, but how long is it going to last is probably more of the issue, because I think you can get away with, having a bad year, not a bad year, but, having a few misses on performance based on a structural shift in what's going on in the index, which is what happened last year. But if that continues for 5 years, I think that's where it is going to start to become very challenging. So that's probably where some of the conversations are, with some of our clients. It's like, we hope that that's not the case and things will correct itself and everything will kind of go back to normal. And to date, for our sustainable fund that excluded fossil fuels, it's performed over the 10-year horizon, it's performed just as well as our core fund. So not having fossil fuels or having fossil fuels has not made a difference in terms of performance over that 10-year period. But in this last year, it's been a challenge, and I think it's been a challenge for lots of managers, not just here, but globally as well.
Yeah. David, your perspective of the New Zealand market?
Yeah, no, some interesting observations there. I think, it comes down to an issue of sort of short-term versus long-term investing, and I don't think anyone would, sort of question the long-term thesis that, volumes, earnings, most likely prices for fossil fuels are going to be lower. I think McKinsey's forecasting 2% volume fall a year through to 2050, and that's even for sort of 2-degree scenario. And when you think, as Mark alluded to, of the number of sort of low-cost producers globally, that particularly more government-oriented oil producers who can pull all that out of the ground at a very low marginal cost, it's hard to see a very high long-term price for oil as those types of producers become a large proportion of a declining total volume of oil that the world would need. So if you're looking at lower volumes and lower prices, the long-term picture is lower earnings, I think, for that sector. And yeah, the short term is different, and that is currently the amount of cash that the industry is producing is very high, and that's what's led to a lot of this shorter term positioning. But yeah, I guess I'd encourage investors to to think about the long term there, and if they are concerned about the sort of performance issues from not investing in fossil fuels, to be really thorough with the way you're engaging with those companies, and make sure that is a really thorough process, and that stewardship, that you can genuinely put your hand on your heart and say that you're in the right companies, they're approaching it the right way, because so many of these big oil companies have net zero targets, etc., but they are extremely flimsy, scope 1 and scope 2 targets. So there is a lot of greenwashing in this sector. I'd encourage those investors to read a broad range of research, not just what the companies are saying and what the investment banks are saying, but have a look at what the NGOs are saying. There's a lot of, very good thought there that to give them, the full spectrum of thought on these issues. I personally think that the valuations for a lot of these companies are quite high at the moment. If you believe that the long-term earnings are going to fall, it's if you put, if you put a sort of declining earnings trajectory into a valuation model, for a lot of them, you really struggle to get where they are now. So it's almost as though the market is assuming that the oil production and those earnings will stay higher over a longer term. So so there's a real inconsistency between what these companies are saying around their sort of ESG and net zero commitments, and what their production plans are, which is the ultimate sort of point that that Carbon Tracker is making. And for investors that are investing in those companies, they're partly responsible when they're sort of buying into that that thesis, if you like, and you know, de facto supporting that messaging of, you know, we're net zero, despite the fact that we're investing in new production that's only useful in a 2.5 degree world.
Yeah, from Mindful Money's perspective, what we've seen is following a number of years of declining investment in fossil fuel companies, over the past year, we've seen a huge kick up in New Zealand investment through KiwiSaver and retail investment funds in fossil fuel companies. And you know, as David said, with long-term data, the current trends aren't necessarily going to continue and are likely to decline. So it's all about, can you get your timing right? And as anyone knows, trying to predict the exact timing of markets is often a recipe for a crisis, as everyone tries to get out at once. So that's the kind of warning of the financial risk. We're going to be providing more information to the public, not only in those trends on fossil fuel investment, but also a categorization of fossil fuel companies between those that are actually on a 1.5 transition pathway, both from their current investment levels and their targets, versus the rest of the industry highlighting those that are actually increasing their production, as Mark Campanale pointed out in his research. The figure was over 60% of the oil and gas sector is still increasing their production at a time when it's not clear that supply will actually be needed or valued in the future. So lots to think about, and I think that was a really useful discussion. Fantastic video from Mark, but also really helpful insights from you both. So thanks very much to Jessica Cairns, who's head of ESG and sustainability at Alphinity Investment Management, and to David Lewis from Novus Consulting, and many other things that David does to help the world. So thank you both very much. I just want to kind of conclude with a sort of a thought around this. You know, this comes at a difficult time for many New Zealanders, and it is 30 years after the climate agreement was first signed at the summit, and I remember being there and being terribly optimistic. Since then, all of the pledges to reduce greenhouse gas emissions have in a way been shown to be a charade. Global emissions have risen by 60%, and New Zealand emissions by 30%. I think this recent cyclone Gabrielle is a reminder we are in a climate emergency and we need to act urgently. That's not somebody else. It's all of us, whether you're in the investment world, whether you're an investor yourself, or whether you're a citizen with responsibilities to play your part. So thanks very much to everyone for helping out on this seminar. Thanks for bearing with us. For those who are online, for some technical difficulties. Thanks very much to sponsors. This new series wouldn't be possible without the generous support of our sponsors. Firstly, to Alphinity, not only for lending us Jessica for the seminar, but for the sponsorship of the seminar, to Mercer, New Zealand Green Investment Finance, and Medical Assurance Society, MAS. With thanks also to our sponsors, Booster, Harbour Asset Management, Chapman Tripp, and Trustees Executors. Thanks also to Pathfinder, and also to Python for their contributions. See you next week, I hope, at a seminar on business purpose in the finance sector. We're asking the question of what is the responsibility of the finance sector towards the public good, and that's including the New Zealand head of B Corp. So we're talking about the B Corp movement. We're talking about business purpose. 12 o'clock next Wednesday. In the meantime, stay active, invest mindfully. Mā te wā.